Welcome back to my channel, and in this video we're going to talk about Disney stock. Previously I made 3 videos on this topic from the moment I start considering the trade, so then you can understand my thought process, to how I make profits on the way down for Disney as the market was correcting, close my shorting position, and then average down as well. And then now Disney has turned around like we predicted. I thought it might be interesting to do a follow-up video on that because some of you have requested, what's the status on Disney? Eric, you're right that Disney turned around, so what do we do now? And how you should think about Disney. That's basically what this video is. So let me just give you a quick recap of what happened and where we started. First of all, I started this video back in around early 2022, around March. So you can see my little cursor here. And at that point, I know that Disney is at a discounted price, but at that point, we don't know where the bottom is. I entered into my Disney position with a hedge. So that's actually something you learn within Investing Accelerator, is how you can make profits both long and shorting the market. In the short term, obviously, the short position paid off. It went down, made profits twice on hedging. So I actually shorted Disney twice. It went down first, took some profits, shorted it again. And my last hedge, I kind of closed it approximately at around $93, which is near the bottom, as we can observe now. So I think throughout this period, I also added a little bit more onto my Disney position to bring down the average price. So now you can see that since then, it has come back up to $120, in fact, $117 as of today, which is Thursday closing price. So this is right after Disney's earnings, and there's a giant jump because obviously Disney is performing very well. And if you have taken a nice summer vacation, which hopefully you have, and been to Disney Park with your kids, then you would have seen that Disney parks are packed. The hotels are expensive, which means they're making money. The parks, they don't have a fast pass anymore, and they're charging these additional fees to basically have a fast pass called a Genie Pass to skip rides, and it basically allows them to make more money while you skip the line. So it's a more profitable business model per se, which is good for Disney as a shareholder holding onto the stock. So great. Now has recovered. One of staff within my company actually bought Disney before the jump. Within 2-3 weeks, he already made around 25%, which is fantastic because I told him you should be patient and wait for the bottom to be mature first. And he's obviously more patient, and he started a little bit later. So right now he's sitting at around 25% profit. There are a couple of things I want to go through with you, a couple of news articles. The first one is Disney Plus raising streaming prices by 38% and offers plan with ads. So that is actually very similar to what Netflix is doing. And when you think about the market share for streaming, you really have Disney owning a couple of networks like Hulu, Disney, and Netflix is doing an ad version plus also price increase. Disney is doing it as well. So it's really, when you have a oligopoly, which means a few players within the market, they have a lot of pricing power. If they increase the price of the content from $10 to $12, there's really nothing much you can do about it except to accept the price, unless you're going down the routes of pirating the movies or someone uploaded on YouTube and you can watch it for a short period of time. But you wouldn't get the full content unless you subscribe to Disney Plus. When you're looking at that industry, in a sense, we're heading back to the good old days where cable is charging you like a monthly subscription and you have the free TV with some advertisements. So that's kind of what they're doing within their own networks. I think we're going backwards a little bit, but that's what happens when you have an oligopoly. Now, the next thing I want to talk about is earnings. Earnings is such a big topic. There's so much uncertainty related to it, but in this video, I want to dive into Disney's earnings and just to help you understand what's important. Because I think a lot of people compare Disney with Netflix recently, but within Investing Accelerator, I don't look at it that way. And, if you're looking at hype, yes, it's easy to focus on comparing Disney Plus with Netflix and think that, hey, if Netflix is gaining or losing subscribers, then Disney Plus is gaining or losing subscribers, so then the stock will go down or up based on that. But if you look at the whole earnings, you look at whole income statements, you would actually come to a different conclusion. You can see this earnings is actually quite long. I'm on Disney's website. But if you just look at this area that I'm highlighting here, that pretty much covers what I want to go through with you today. For July 2nd, 2022 quarter, the segment revenue is 21 billion. So this is in millions. So 21,000 million is billion. And you'll see that Disney Media Entertainment Distribution is 14 billion and Parks, Experience, and Products is 7.3 billion. So that's great. Now you have a brief idea of how the revenue is distributed. Well, so what? The question is, well, where is Disney Plus? Okay, so you need to actually have a deeper breakdown of this. So you go down a little bit, then you go to linear networks, okay, 7 billion, direct to consumer 5, content sales 2, and some inter-segment stuff. Don't worry about this. It's just an overlap of revenue, 14 billion. Disney Plus sits in direct to consumer because Disney is such a big company. Disney Plus is actually just part of this 5 billion. Now, they don't have a further breakdown, but I think I would say a good chunk of this should be Disney Plus, hopefully. And if we just zoom back out, 5 billion divided by 21 billion. It's approximately 25%, but let me just take out this 5 divided by 21 is 23.8%. So it's all right, is significant, but we are kind of ignoring the remaining 75% of it. And that's what I'm trying to get at. The focus of Disney business going forward is not Disney Plus. Yes, it is growing by 19% a year, which you can see here. But if you look at content sales, that's 26% growth. Wow. If you look at Disney Parks Experience, that's 70% growth. And this is actually the investment thesis we narrowed down within Investing Accelerator is the parks, the movies as well coming up, the experiences like cruises and all that stuff is a major source of revenue that Disney will benefit from post-pandemic. So going forward, what you'll hear is that there is going to be less emphasis on Disney Plus. Because let's be honest here, we are heading into a post-pandemic world. And if you're like me, you probably don't want to be locked in your house and not travel. You probably want to travel. You probably want to go to a Disney park with your kids. You probably want to get on a Disney cruise or watch some movies, which is a very normal thing to do. That means you're going to be spending money in things that are not Disney Plus. So yes, the growth might be slower in the future, and Disney actually reduced their forecast for the subscriber growth next year. But the emphasis is actually on the parks experience, how they're increasing the prices and making different like packages that actually allow them to charge more money, or Disney Hotel is charging a lot more money as well. So that allowed Disney to recover a lot quicker in the post-pandemic world. Now we have a relatively good understanding of how to think about Disney, the fundamentals of why Disney is successful and why it's a good investment. It's quite obvious in hindsight. When we look back in the last 12 months, you'll be like, well, Eric, duh, like it's so obvious, like anyone could have seen it. It's always obvious in hindsight, and you should apply this kind of thinking forward, and that's how you become a better investor. So then the only thing left remaining is really, where's the bottom? How do you time it? Your patience, entering, and then having that conviction to hold through the dip. Because let me tell you another story. So one of my subscribers watched my video. I think she entered somewhere here in the very beginning, which obviously she's early. We all know that. And I told her, hey, it is long-term investments, 12 to 18 months. So don't panic. Now, using shares, you don't have that flexibility. You can't like short the market, and you can only hold. And she was really scared, and she exited around $90-something, right where the bottom was. And afterwards, Disney turned around, and I guess she might feel a little bit sad. Even if myself and herself have the same information, but if the mindset, the investing strategy, and the understanding of the business is different, it'll lead to different investing results. That's why it's very important to get that complete understanding of the business and do your research when you're investing, because if you don't have that conviction, which is the logic you build your investment thesis on, and you just follow someone's on their stock pick, then you're not going to know what to do when the trade goes against you for 3 months. And if I go back to the chart here, well, would we have known that July 11th was the exact bottom before the turnaround point? And the answer is, well, you wouldn't. And that's what uncertainty is. And you need to have that conviction that, well, the turning point is going to be coming up. And you know it is, because you know the parks are going to be reopened. And you know a lot of people are going to the parks. So logically speaking, it has to be performing better in the future, right? And that's kind of the way I think about investing, is I look for these very likely and logical investments that will happen in the future. That's what I invest in. So let's say we know 6 months ago that Disney parks are going to be reopened and a lot of people are going to Disney and they're going to be making a lot of money. So if you know that 6 months ago, wouldn't you invest in Disney during that time? And I think the answer is yes. So your job as an investor is to understand that uncertainty, understand the risk, and what is the benefit, what is going to happen with the business, and invest according to that. Your job as an investor is not to just listen to some guy's advice, watch a random YouTube video, or read a news article on MarketWatch and go like, oh, yeah, let's go buy that. Let's throw in $100 in there. You need to do your own research. Because if you don't know what you're waiting for to happen, then you're not going to have the conviction to hold until that happens. And in this case, we're waiting for the parks to reopen, travel to reopen, people to spend money at Disney parks, and the movies to come out. And going forward, well, one of my other subscribers asked me, do you think Disney will be going down? And is this rally going to last? Is this a fake bull rally, like a bull trap? And that is actually quite interesting. So let's go to the next chart here. So this is the revenue forecast for Disney. It's actually public information, but most people don't know how to pull it out. And I use this website called Estimacy. It's just a cooler looking visualization to help you out. So here you can actually see in Q1, there's going to be a bump in revenue. So that is a good sign. Q2 is a little bit slower season. And then Q3 is going up again. So if you look historically, Disney actually has quite a positive trend for revenue because it goes up after every single quarter. And for Q4, Q1, there's that jump. Usually it's related to Christmas, and that kind of makes sense. So I should expect the stock price to be going up during that time as well. And then there should be a dip in Q2-ish because the financial performance is also a little bit lower. So it's not going to be as hot per se. And then later on in Q3, it's going to be going up again. So it is going to be volatile. It's going to be bumpy. And if we dive into in-depth technical analysis, then what you're trying to achieve here is to plan your exit. And I actually will cover this in a weekly group coaching call this week for Investing Accelerator. But what you're trying to achieve is to observe where the resistance are. And when the momentum slows down, then you take profit. So you can see that, hey, Eric, you didn't give me an exact price point to exit. And that is really because when you're in a rally, you need to understand when the momentum slows. And you can only exit when the momentum slows. If the price starts going up slower and slower, then you're likely reaching your first top. So there are going to be multiple tops if you're investing in a stock like Disney. And usually you would exit at the first or second top and take a good profit that you're happy with. So in this case, here you can see, let's say some resistance are at around $140, $130. So that's kind of the area you're going to be watching out to see if Disney has a slowdown in stock price. And then if it comes back down and you did an exit and you're holding shares, you can hold longer. You can hold till the next travel season, which is next summer. And there's probably going to be a second rally. So if you're long-term investing and you got in at a good price like 110, 100, then you can hold on to it for the next 6 to 12 months. And if you're continuously making money, then you hold until the momentum slow. Now, one of the things you see on my chart here is actually this blue line. Now, this is actually a very rough wave pattern blue line that I drew. And I actually drew this back in around June, before the turning point happened, because I was actually expecting the turning point to happen somewhere in May, June, July. So it happened in like late June, which is fine. So you can see I actually didn't revise this blue line yet. It kind of matches with the pattern so far. So I do expect Disney to encounter some resistance near this 140 range. It's not going to be like a straight rocket to go all the way up to 180. That would be fantastic for me, but I don't think that's going to be the case. So it's going to be going up and down, don't panic. And what's important is that you hold on until you observe the momentum slows. So that's why we have weekly group coaching call in Investing Accelerator, because sometimes when you're investing in the market and you're aiming for a good exit point, you need to track the markets on a weekly basis. 1 to 2 hours a week is more than enough. Like personally, if I'm traveling, I would probably use less time and just track the markets when, at the end of the day, when the market is closed, basically. Now the market is going up. It's going to be easier to invest and easier to make money. Some people like to say that everyone is a genius in the bull market, but I think the reality is you need a bull market to make money, because in order for stock investing to work, you need a difference in price, meaning that price needs to go up for you to make money. Now we're stepping into a bull market, so you should focus on making money then. That's it for this video. Short and simple. Hopefully next time I'll be taking profits, and I'll be sharing the amounts of profit I made, percentage-wise, where I took profits and why. And I'll see you in the next one.